Hello and welcome to our channel. Today we are going to dive deep to the world of demand guarantees and standby letter of credit. These are powerful tools used in international trade and finance, offering protection to both parties in the transaction. We will also explore key technical terms, categories, and the underlying relationship involved in these instruments. So, whether you are a student of finance, a business owner, or a professional in the industry, this video is for you. Let's get started. To begin, let's define what a demand guarantee and a standby letter of credit are. A demand guarantee is an irrevocable undertaking by a guarantor to pay the beneficiary upon a complaint demand, meaning that the beneficiary does not need to prove a breach in underlying contract. The payment is triggered by a simple demand as long as it complies with the terms of the guarantee. A standby letter of credit operates similarly, providing an irrevocable promise to pay upon a complaint demand. While both demand guarantees and standby letter of credit share similarities, there are some distinctions in how they are used and categorized, which we will explore later in this video. These instruments are independent of the underlying relationship between the applicant and beneficiary. This independence is crucial as it allows these instruments to function without getting entangled in the specifics of the underlying contract. Now, let's talk about the categories of the standby letter of credit. Just like demand guarantees, standby letter of credits cover risk like default in performance or payment. However, most standby letter of credit are issued to cover the risk of default in payment, as emphasized by Burney in 2024. Standby letter of credit originated in USA and they are still widely used in North America for both domestic and foreign transactions. In the USA, there are an additional type of standby letter of credit which is called the direct pay standby. Unlike regular standby letter of credit, a direct pay standby letter serves as the primary payment mechanism rather than just protection against default. In this case, the beneficiary can seek payment whether or not the applicant has defaulted. However, since this type of standby is mainly used in the USA, we won't go into further detail in this course. Let's move on the concept of underlying relationship. Although a demand guarantee or a standby letter of credit is typically issued in relation to an underlying contract, this isn't always the case. For example, a tender guarantee, that is a bid bond, is issued before a contract is finalized and may be called upon if no contract is signed. This might happen if a bidder withdraws their bid prematurely or fails to sign the contract even after the winning bid. Similarly, a customs guarantee is provided to cover the temporary import of goods or equipment. If the goods aren't re exported within the designated time frame, the customs authority may call the guarantee for the amount of duty payable. Although we often refer to the underlying contract or underlying transaction, it isn't more accurate to refer the underlying relationship, which can take many forms. Cost of demand guarantees and standby letter of credit. Next, let's talk about the cost involved in issuing demand guarantees and standby letter of credits. Bank charge for these services, and while the specifics of the charging are outside the scope of this video, the cost broadly depend on several factors. First one, the value of the instrument. Second, the validity period of the instrument. Third, risk of the beneficiary making a call. Fourth, the risk of the bank being unable to obtain reimbursement from applicant. Additional costs come into play when a counter guarantee is involved, which we will define shortly. Keep in mind, banks that are subject to capital adequacy regulations may need to make provision for the guarantees they issue. This can affect the pricing and availability of demand guarantee and standby letter of credit. Key technical terms and definitions. Now let's move on some key technical terms that are essential for understanding demand guarantees and standby letter of credits. Demand guarantee. This is an independent guarantee payable on demand. It is also called a first demand guarantee, on demand guarantee, or bank guarantee. The ICC prefers the term demand guarantee and has standardized its usage through the uniform rules for demand guarantees. Counter guarantee. This is a demand guarantee given to the issuer of another demand guarantee, often issued when two banks in different countries are involved. A counter guarantee is sometimes referred to an indirect guarantee. Suretyship guarantee or accessory guarantee. This is a secondary guarantee in which the guarantor only pays if the applicant defaults. It differs from demand guarantee because the guarantor has legal defenses that wouldn't apply under demand guarantee. The term bond could refer to performance bond, bid bond, or others, and may describe either demand guarantee or suretyship guarantee. It is important to examine the text of the instrument to understand its nature. Commercial documentary letter of credit or documentary credit. This is an independent irrevocable undertaking by a bank to make payment upon presentation of a stipulated documents, provided all terms are met. It is different from a standby letter of credit because a documentary credit is the primary payment mechanism. Independence. Both demand guarantees and standby letter of credits are independent from the underlying relationship between the applicant and beneficiary. This means the instruments aren't influenced by dispute in the underlying contract. Irrevocable. A demand guarantee or standby letter of credit is irrevocable, meaning it cannot be changed or revoked without the beneficiary's consent. This ensures the beneficiary protection until the guarantee's expiration date. Guarantor or a counter guarantor. The guarantor is the party that issues the demand guarantee, typically a bank. The counter guarantor is the party that issues the counter guarantee, also usually a bank. Issuer. The issuer is the party that issues a standby letter of credit. Typically, this is a bank but can also be another entity. The term issuer is used broadly to refer to issuers of both demand guarantees and standby letter of credit. Applicant. The applicant is usually the party for whom the demand guarantee or standby letter of credit is issued. Sometimes the term principal is also used instead. Expiry date. This is the last date on which a demand or a drawing can be made under a demand guarantee or a standby letter of credit. Demand or presentation or drawing or a call. These terms are used interchangeably, but it is important to understand their precise meaning depending on the context of the demand guarantee or standby letter of credit. A complying presentation is one that adheres to all terms and conditions of the instrument. And that's bring us to the end of today's video. We have covered the major categories of standby letter of credit, the underlying relationship, the cost involved, the key technical terms related to demand guarantee and standby letter of credit. Understanding these financial instruments is crucial for everyone involved in international trade finance. If you found this video helpful, make sure to like, subscribe, and leave a comment if you have any questions or suggestions for future topics. Thanks for watching and see you in the next video.